trillions of dollars in bonds once marketed as untouchable safe havens are now being dumped at pennies on the dollar. This is happening under the radar, and it matters right now. If you hold investment-grade bonds, agency debt, or safe credit notes, your portfolio could be at a breaking point. In this video, you will see what triggered the plunge, who's offloading, the hidden risks most investors ignore, and where the value traps lurk. Time-sensitive decisions are being made behind the scenes. Let's get inside the bond dump before the headlines hit your statements. The safe label trap. It started quietly, the kind of shift that hides in plain sight until it's too late to ignore. For decades, government bonds and high-grade credit were the cornerstone of safety. The place you went when you didn't want surprises. Every brochure called them risk-free. Every advisor said, you can't lose on treasuries. But that promise was only ever about credit, not price. When rates surged, that illusion shattered. A 10-year treasury bought near 0% yields now trades around 80 cents on the dollar. Some agency mortgage bonds are even cheaper. The borrowers will still pay back, yes, but time became the new risk. Because when liquidity vanishes, even safe assets can trade like distress sales. Inside the banking system, the story turns darker. Portfolios stuffed with low-yield paper are showing billions in unrealized losses. Those bonds were meant to be held to maturity, a label that sounds stable until depositors start withdrawing cash. Then, the safest line item on the balance sheet turns into a liability overnight. And it doesn't stop there. Insurance companies, pension funds, and bond ETFs are all trapped in the same cycle. They believed yield had vanished forever, stretched maturities, and trusted the central banks to keep rates low. But when inflation roared back, duration became dynamite. Now trillions in supposedly safe bonds are being dumped at steep discounts, not because the issuers defaulted, but because confidence did. The phrase risk-free no longer means loss-free. The label said safe. The market says otherwise. And next, we'll see what happens when the institutions holding these bonds finally run out of patience and start to sell what they swore they'd never touch, from par to pennies. It began subtly, bonds that looked perfectly fine suddenly trading at bargain bin prices. At first, dealers called it temporary. But the shift wasn't a blip. It was the new baseline. The same securities once sold as the safest in the world, treasuries, agency mortgage bonds, top-grade corporates, are now changing hands far below par A. 10-year treasury, bought in 2021 for $1, now fetches about 80 cents. Mortgage-backed paper from that era can trade even lower. These aren't risky bets. They're the foundation of the global system. But when rates rise fast, old bonds lose their shine. The new ones pay more, and yesterday's safe yield becomes today's dead weight. For banks and funds, that means trouble. When one institution sells at a loss, it resets prices for everyone else. Unrealized losses spread like cracks through balance sheets. Regional banks and even insurers are quietly unloading huge bond portfolios just to stay liquid, even if it means accepting pennies on the dollar. The irony is that most of these bonds will still pay back in full, just not soon enough. Time, not credit, is the killer. Few institutions can wait 10 years for redemption, when redemptions, withdrawals, and margin calls hit next week. So they sell, not out of fear, but out of necessity. Each discounted sale sets a lower benchmark, pulling the whole market down another inch. These aren't panic trades, they're survival trades. And the deeper the cuts go, the more pressure builds for the next round of forced selling. Because once the bondholders start to break, the next wave doesn't come from investors. It comes from the banks themselves. Banks' bond hangover. For banks, this isn't a paper problem anymore. It's a balance sheet migraine. The story starts with portfolios built in the zero-rate years, when treasuries and mortgage bonds looked like free money lend at 2%, borrow near zero, and pocket the spread. It worked until rates exploded. Suddenly, those same safe assets were down 20, even 30%. On paper, most banks called them held to maturity, meaning they didn't have to show the losses. But the market doesn't care about labels, depositors do. When customers started pulling cash for higher yields elsewhere, banks needed liquidity, fast. And that's when the illusion cracked. Selling even a fraction of those bonds meant realizing losses big enough to erase years of profit. After the regional bank scares of 2023, regulators knew the problem, but had no quick cure. The Bank Term Funding Program gave lenders a way to borrow against those underwater bonds at full value, but that safety net expired in early 2024. Without that lifeline, some banks face the same trap all over again: rising funding costs, shrinking deposits, and portfolios they can't sell without bleeding. Behind the scenes, smaller institutions are already unloading what they can. Packages of treasuries and agency MBS are quietly hitting secondary markets at steep discounts. For every bond they sell, the next one is worth a little less. It's a slow, grinding repricing that exposes just how thin their capital cushion really was. The result is a silent feedback loop. Losses force sales, sales push prices lower, and lower prices deepen the losses. For investors, it means the floor under the bond market isn't firm. It's built on the same portfolios that were supposed to keep the system stable. And as those positions unwind, the next question isn't whether bonds recover. It's who runs out of patience first: the banks, the regulators, or the markets watching both. Receivership fire sales. When a bank finally breaks, the cleanup begins. And that's when the real price discovery hits. Once regulators step in, every bond, loan, and mortgage-backed security on that balance sheet is dumped into an FDIC auction. These aren't quiet events. They're liquidation floors where billions in safe assets trade at steep discounts. And every bid sets a new low water mark for the rest of the market. In 2023 and 2024, when mid-sized banks failed under the weight of unrealized losses, the FDIC sold off their portfolios in bulk. Whole pools of treasuries, agency MBS, and municipal debt were packaged and auctioned to hedge funds and private buyers, often for 70 to 80 cents on the dollar. The government didn't want to crash the market, but price is truth, and those auctions told it loud and clear. Each sale didn't just clean up one failed bank. It rewrote the pricing model for everyone else still holding similar paper. Once a safe 10-year note sells for a 30% haircut, every other balance sheet using that bond as collateral has to mark it down too. The contagion isn't psychological, it's mathematical. And the ripple effect spreads fast. Buyers at those auctions aren't long-term investors, they're opportunists. They buy distressed paper cheap, repackage it, and flip it once the panic cools. But their bids define the market in the meantime. That's why even stable institutions suddenly find their valuations sliding, despite no change in fundamentals. In short, every receivership sale sets the new benchmark. It's how the market silently resets the definition of safe. The next time you hear about a bank collapse, remember, it's not just a local story, it's a price signal. And those signals are starting to flash again. Because behind each orderly resolution, another question looms. How many more portfolios are one margin call away from the same fate? Treasury buybacks versus market floods. The US Treasury says it's fixing the problem, and in theory, it is. The new buyback program was designed to calm bond markets by purchasing older, off-the-run treasuries that no one trades anymore. On paper, that sounds like stability. In reality, it's a thimble trying to drain an ocean. The Treasury's weekly buybacks add up to a few $1 billion, a drop compared to the trillions in bonds still sitting underwater on bank and fund balance sheets. For every dollar repurchased, multiple more are being sold by institutions desperate for liquidity. Liquidity has split in two. The newest treasuries, the ones dealers quote every day, still move easily, the older ones. They trade like relics. Market makers avoid them, inventories are thin, and bid-ask spreads stretch wider each week. The result is a two-speed bond market, one still smooth, one stuck in mud. Buybacks can't fix that. They're not price support, they're damage control. The goal isn't to make investors whole, it's to stop the system from seizing up. And as rates stay high and supply keeps pouring in, those limited buybacks can't outpace the selling pressure. So while the headlines sound reassuring, the math isn't. The government's steady hand may keep the gears turning, but it doesn't change the weight pressing down on them. And just below treasuries, another class of safe bonds is cracking even faster: the mortgage market. Mortgage-backed whiplash. Just below treasuries on the safe list sit the agency mortgage bonds, the ones backed by Fannie Mae, Freddie Mac, and Ginnie Mae. Supposedly government guaranteed, supposedly rock solid. But lately, they've been anything but calm. These securities were built on the idea that homeowners would refinance often, paying investors back early, for years. That steady churn made them predictable. But once interest rates spiked, that flow stopped cold. Homeowners locked into cheap pandemic mortgages aren't refinancing, so cash flows slowed to a trickle. That's the nightmare called extension risk. The bond that was supposed to mature in 5 years suddenly behaves like a 15-year note. Duration balloons, prices drop, and liquidity evaporates. Even with full faith guarantees behind them, these bonds can trade 20 or 30% below face value, safe on paper, painful in practice. For banks and insurers, it's worse. Mortgage portfolios once treated as liquid collateral now sit frozen. If they sell, they lock in massive losses. If they hold, they tie up capital. Dealers know this too, so bid prices keep slipping lower, widening the gap between what the models say and what the market will actually pay. And when one firm finally capitulates and sells, that lower price becomes the new benchmark for everyone else. It's a chain reaction that pushes valuations down across the system. What was meant to be the next best thing to treasuries is now acting like a trap, one that tightens every time mortgage rates tick higher. The irony: these bonds will pay out, just not soon enough for the leveraged investors holding them. And when patience runs out, the next wave of selling begins, this time from the institutions that can't afford to wait another year for safe to come back to par. The insurer duration squeeze. Insurance companies were supposed to be the calm in the storm, long-term investors with deep pockets and steady hands. But even they're feeling the pressure now. Their balance sheets are packed with long-dated bonds bought during the low-rate era, and every rate hike stretches their liabilities while crushing the value of those assets. For years, insurers bragged about matching assets and liabilities perfectly. Premiums came in, payouts went out, and the bond portfolio in between quietly earned its yield. But as rates climbed, that math fell apart. The long-term bonds meant to fund future claims are now worth far less, while new policies demand higher guaranteed returns. The spread that once meant profit has turned into pain. On paper, the losses don't always show. Insurers use accounting rules that smooth volatility. But behind the scenes, they're shifting billions to stay solvent. They're selling older treasuries and agency bonds at discounts and moving into private credit, structured products, and riskier loans just to keep yields above their promises. It's a quiet reach for return, dressed up as diversification. The danger is time. If claims rise faster than expected, or if regulators tighten capital rules, those paper losses could become real overnight. Some firms are already lobbying for looser reserve requirements, warning that forced mark-to-market accounting could trigger fire sales. In short, even the most conservative investors are now gambling on stability. The bond market's backbone, insurance capital, is starting to bend. And when that kind of long-term money begins to flinch, it tells you just how deep the cracks have gone. Next up, we'll see what happens when the fastest money in the system, hedge funds, runs out of room to hide. Hedge funds, basis trades, and forced de-risking. Hedge funds aren't supposed to panic. They're built to profit from it. But in the bond market's current storm, even the smartest leverage has started to unwind. For years, funds played a quiet game called the basis trade, borrowing short-term cash to buy long-term treasuries, hedging the rate risk, and pocketing the tiny difference between futures and cash prices. It worked beautifully when funding was cheap. Then rates jumped, collateral haircuts rose, and the cost of leverage doubled almost overnight. That thin spread disappeared, leaving funds holding billions in bonds, financed with short-term loans that suddenly weren't cheap or stable. When margin calls hit, they had two choices: post more collateral or start selling. Most sold. Those sales ripple fast. Hedge funds don't unload slowly. They dump positions in bulk through dealers and clearing systems, sending prices lower with every round. Even safe assets like treasuries can gap down when too many leveraged players try to exit the same door. It's not about fear, it's about physics. The danger is how invisible it looks from the outside. When you check your bond ETF and see a small daily drop, that move might represent billions in forced liquidations behind the scenes. Each of those trades resets the reference price for everyone else holding similar securities. It's a chain reaction. Margin calls create selling. Selling drops prices. Lower prices trigger new margin calls. That feedback loop doesn't end until leverage clears. And every time it happens, the market's definition of safe yield slips another notch lower. The next wave isn't driven by fast money, though. It's driven by the funds meant to be stable. Mutual funds, ETFs, and municipal portfolios facing redemptions they can't ignore. How it hits you: ETFs, funds, and muni spillovers. You don't need to be a hedge fund to feel the damage. It's already trickling down to ordinary investors. Open your brokerage app and look at your bond ETF. The price might not match the value of its holdings anymore. That gap, the discount to NAV, is the quiet proof that liquidity is breaking. When redemptions rise and market makers hesitate, funds can't sell fast enough to meet withdrawals. So they mark prices lower, cut distributions, or quietly pass losses down to shareholders. It's not mismanagement, it's math. Mutual funds and ETFs promise daily liquidity, but the bonds they hold don't trade daily anymore. When investors want their money back all at once, managers are forced to sell what they can, not what they want. That means the most liquid, highest quality assets go first, leaving the weaker paper behind. Over time, that makes the remaining portfolio riskier. Even as it looks safe on paper, municipal bonds are feeling it too. Cities and states haven't defaulted, but dealer inventories are thin and buyers cautious. So when fund redemptions spike, muni prices tumble right alongside corporate and treasury markets. Yields climb, but few step in, not when they expect cheaper prices tomorrow. Even the popular core bond funds, the ones pitched for retirement accounts and stable income, are quietly bleeding. They're selling old, low-yield positions to buy new, higher-rate paper, locking in losses just to keep up with benchmarks. For investors, it feels like nothing is safe anymore, because right now, nothing truly is. This is the part of the cycle where the pain spreads outward, from the professionals to the public. And the next layer isn't about what you own. It's about what you can still trust: the data, the marks, and the timing that decide when this market finally stabilizes. Playbook: spotting value versus value traps. When everything looks cheap, the hardest question isn't what to buy, it's what's real value and what's just a trap. The bond market right now is a minefield of discounts that aren't actually deals. Some prices are low because panic sellers dumped good assets. Others are low because those assets won't recover, even if rates fall. Knowing the difference is what separates opportunity from disaster. Start with time. A bond's value depends less on its coupon and more on how long you can afford to wait. If you need liquidity in the next year, even the safest bond can burn you. But if you can hold through the volatility, those same discounts can become long-term gains once yields finally normalize. Patience, not prediction, drives profit here. Then there's structure. Off-the-run treasuries and high-quality corporates might be mispriced simply because no one wants to warehouse them right now. But complex securities, older mortgage pools, structured credit, callable notes carry layers of risk that even professionals struggle to model in this environment. A low price doesn't mean a bargain if the cash flow is uncertain. Finally, watch the auctions. Secondary markets and treasury buyback data reveal where real buyers are stepping in. If volumes rise while bid-ask spreads tighten, it means liquidity is returning. If prices fall on light volume, the bottom isn't in yet. The smartest money waits for that alignment, shrinking supply, rising bids, and quiet stability before committing. Because this moment isn't about chasing yield. It's about surviving the unwind. The investors who stay patient and liquid will be the ones buying from forced sellers instead of becoming them. And that brings us to the final point, the larger signal behind all of this. Because what's happening in bonds right now isn't just a market correction, it's a test of what safe truly means in a system built on debt. The phrase safe investment doesn't mean what it used to. Trillions in supposedly stable bonds are being dumped at fire sale prices, not because they're bad assets, but because time, leverage, and liquidity turned against them. Banks, insurers, and funds all built their balance sheets on the same assumption, that low rates would last forever. That illusion has now unraveled in real time. The truth is, we're watching a slow-motion reset of the global financial system's foundation. When even treasuries trade like distressed assets, every other market takes notice, from real estate to equities to the cash in your savings account. But within every correction lies a map for opportunity. The investors who survive this aren't the ones chasing rebounds. They're the ones tracking the data, reading the signals, and waiting for the forced sellers to run out of room. So, if you've seen the cracks forming, don't look away. Audit what you hold, question what's called safe, and follow the money, not the marketing. Because this story isn't ending, it's just beginning. Stay alert, stay liquid, and if you want to see exactly where the next wave is building, hit subscribe. The numbers never lie, but they don't wait either.